US jobs growth beats economists' forecasts, which lifts the S&P 500 to another record high and reduces market expectations for Fed rate cuts this year to 50 basis points. And Australia's trade surplus halves in May. That's coming up on our 5 Things in 5 Minutes on Friday, July the 4th. And then, in our deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, looks at how growing US deficits will see Asian investors diversify away from the world's largest economy.
Net, what it means is that if I was an investor in the US, it would sort of now pay, or it would be rewarding to start to diversify my holdings across the globe.
But first, in 5 and 5 with ANZ, US jobs grew 147,000 in June in non-farm payrolls data overnight. That was stronger than the 110,000 that economists had forecast. Stock investors celebrated, pushing the S&P 500 up to a new high, and bond traders reduced their expectations for Fed rate cuts this year. But the better-than-forecast number flattered to deceive a bit, as ANZ economist Bansi Madhavani explains this morning from London.
Looking beneath the surface, though, tells you that the labour market was not as strong as the headlines would imply. Around 63,000 jobs were added in the state and local government education sector, which drove the upside surprise in the overall report. Private sector employment is in fact slowing. If you exclude education and healthcare sector, private sector job growth has been below trend since the start of the year. That signals that underlying employment momentum is weakening. For now, the data reduces the pressure on the Fed to cut rates as early as its July meeting.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 had closed up 0.8% at a new record high. The US 10-year Treasury yield was up 5 basis points to 4.34%. Gold down 0.6% at $3,334 an ounce. And West Texas Intermediate futures were also down 0.6% at $67.03 US a barrel. The US dollar index rose with those US interest rates up 0.4%, which meant the Aussie dollar fell 0.2% to 65.72 US cents. And the Kiwi fell 0.3% to 60.67 US cents. Number 2. Bansi says rate cuts by the Fed are still on the cards, although market expectations were pegged back around 16 basis points overnight.
But if there is further cooling in the labour market, we think that warrants easing later in the year. Our view, therefore, is that the Fed will cut rates twice this year. In terms of market reaction, financial markets have pared back their expectations for rate cuts to 50 basis points this year, down from 66 basis points priced at the start of the week.
Number 3. Australia's merchandise trade surplus halved in May to 2.2 billion Australian dollars. Imports rose 3.8%, while exports fell 2.7% from April. Here's ANZ economist Sophia Angala.
Imports of aircraft and confidential items, which rose over 260% through the month of May. And when you look at the export values, what largely drove that decline was that non-rural goods category, which also looks at commodity exports. Resources exports declined by just over 2.5% through May, and what largely drove that decline was an over 11% monthly drop in other mineral fuels exports, so that captures LNGs.
Number 4. Traders are starting to turn their attention to US trade announcements as the 9th of July tariff pause approaches. A deal with Vietnam this week has raised expectations and questions about how the others may be reached. ANZ Head of FX Research, Marja bin Zaman, says this ongoing uncertainty will weigh on the US dollar.
Now, of course, in July, the focus is really going to be on the US tariff pause next week. Again, recent commentary by the administration suggests that the vacillation, as we have observed over the last couple of months, will continue. In our view, policy uncertainty remains the key driver of the weaker sentiment that we have seen around the dollar. Further to that, of course, we've also seen reallocation of flows, change in investor preferences, and that has probably going to continue to drive the long-term shift lower in the dollar.
Number 5. British bond markets have experienced a wild ride in recent days, with fiscal concerns triggering a rise in gilt yields. Prime Ministerial support for the Chancellor and the government's fiscal rules then led to a calming of markets. Marja bin says a number of factors may still weigh on the British pound, though.
We do expect the Bank of England to ease policy rates by 75 basis points in the next couple of months, taking terminal rate to 3.5%. We've also seen Governor Bailey flag softness in the labour market and subdued credit demand as growth concerns are increasing. So putting it all together, fiscal concerns and softer macro environment and the BOE stepping on the path of maybe easing more aggressively in combination point to a little bit of weakness in the sterling from here in the near term.
Majapin Zaman there. Now, in our deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, explains why Asian investors with US portfolio holdings are set to diversify away from the world's largest economy.
US fundamentals have been quite weak when we look at the combination of the budget deficit and the current account deficit. And that has really made them a debtor nation. It's always been the case, but if you just look at the extent of indebtedness now, that's running close to 90% of GDP. And that's a high number. Now, to be sure, that has always been there, a deficit, and it's just been progressively worsening over the years. But where it now clashes with, and what has sort of brought this issue to prominence, is the fact that the administration's restrictive policies, be it tariffs, be it immigration, all these, and also, we're talking of the broader general direction of US policies in terms of the big, beautiful act, budget deficits, etc. All these have now added up and have brought this particular issue to attention of investors.
And obviously linked to those twin deficits is Asian portfolio holdings of US assets. You're saying in the note that Asian investors will diversify away from the US. Is that due to the short-term uncertainty created mainly, do you think, or just the ongoing structural nature of those deficits?
I think it's a combination of both. So we've had structural problems, and then you've had a policy that could turn out to be cyclical, that could turn out to be a durable one. But net, what it means is that if I was an investor in the US, it would sort of now pay, or it would be rewarding to start to diversify my holdings across the globe.
Where do you think those investments or those holdings will go if they do leave the US?
Yes, so it's early days. They would obviously be sort of sprinkled over Europe, over Asia. And I guess the high point over here is that if we look at the depth of Asian markets, we look at how much flows they've had, the impact on Asian economies, particularly the deficit ones, India, Indonesia, and the Philippines, that could be quite substantive, both in terms of flows, in terms of how we value assets in Asia. All these dimensions could change.
What types of investors, will different types of investors diversify at different times? I guess they're holding different assets, and you've got different types of investors, i.e. central banks and the like. Will they go at different times?
Yes, I think we should classify the Asian investor into two types. The first would be central banks, which have generally been very slow to diversify from US treasuries, largely because of the safety, the liquidity of the US Treasury market. But then you have this other class that has grown a lot, which is a combination of pension funds, sovereign wealth funds, mutual funds, life insurance corporations. And this segment is the one that is likely to drive the diversification. Within that, I would say that the economies where you find these investors are large, they really include developed Asia, Hong Kong, Singapore, Korea, and Taiwan.
And do you think this diversification itself will be structural or temporary? Are people waiting to see those twin deficits of the US reduce or political uncertainty reduce? And will portfolio flows go back to the US at some point?
I think they can potentially go back to the US at some point in time, but at least over the next 3 to 5 years, I would say that this diversification would reside in other economies.
Sanjay Mathur there. I'm Bernard Hickey. That was 5 and 5 with ANZ for Friday, July the 4th. Catch you next week as we look ahead to 2 key rate cut decisions by the RBA and the RBNZ. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.